For decades, Japan has stood as one of America's most unwavering allies in Asia, a dependable partner that shaped its foreign and economic policies in alignment with Washington's expectations. But a new chapter is unfolding, one that signals a dramatic recalibration of Japan's national priorities. Under the leadership of Prime Minister Chagaru Oshiba, Tokyo is no longer content to play the role of a loyal subordinate in a decades-old alliance. With increasing urgency, the Japanese government has declared that it will no longer sacrifice its own national interests at the altar of U.S. strategic imperatives. The nation's focus has shifted inward, towards stabilizing and revitalizing its own struggling economy, even if that means distancing itself from American demands. This shift is not symbolic, it is tangible, deliberate, and already in motion. One of the clearest and most controversial signs of this new posture came when Japan resumed oil imports from Russia, openly defying the sanctions led and enforced by the United States and its Western allies. This decision isn't a mere footnote in a long diplomatic history. It marks a seismic shift in Japan's foreign policy, an open assertion of independence from Washington's sphere of influence. But it doesn't end there. Only weeks earlier, Tokyo issued a rare and stark warning about its surging national debt, a public financial red flag waving in the face of a growing crisis. Yet from the United States came nothing. No financial support, no diplomatic outreach, not even a hollow promise. Just silence. This silence is deafening, especially when one considers that Japan is the largest foreign holder of U.S. Treasury securities, holding more than $1.1 trillion in American debt, money that has, over the years, helped prop up U.S. wars, bailouts, and budget deficits. Now, under economic strain exacerbated by lingering Trump-era tariffs and unresolved trade tensions, Japan is quietly but seriously considering reducing its U.S. bond holdings. Such a move would have been unthinkable even a few years ago. But now, the idea of selling U.S. treasuries is on the table, a calculated signal that Japan is prepared to prioritize its economic survival over the symbolic maintenance of an alliance that no longer feels reciprocal. For the first time in more than a generation, Japan is telling the world that its loyalty has limits. This quiet rebellion is playing out against the backdrop of a larger global transformation. The world's reliance on the U.S. dollar, once the bedrock of global trade and finance, is beginning to erode. The BRICS nations, Brazil, Russia, India, China, and South Africa, have not only begun distancing themselves from the dollar, but are now building an alternative system altogether. Over 20 other countries have either joined or expressed interest in joining this new bloc. Brazil is even exploring the possibility of conducting international loans in Chinese yuan instead of U.S. dollars. These developments, while still in their early phases, are shifting tectonic plates beneath the global financial system. Meanwhile, the United States is drowning in its own economic troubles, with national debt nearing $37 trillion and international appetite for U.S. bonds dwindling rapidly. Should the BRICS bloc and its allies fully transition their financial systems away from the dollar, it could quietly but irreversibly dismantle the global architecture of American financial dominance, an architecture that has underpinned U.S. geopolitical power for nearly a century. All of this is happening while the average person remains completely unaware. The headlines focus elsewhere. The public is distracted. But beneath the surface, a new reality is emerging. One in which U.S. global supremacy is being re-examined, resisted, and, in some corners, rejected. Japan's resumption of Russian oil imports might appear at first glance as a narrow energy decision. In truth, it's far more than that. It is a symbolic rupture, a visible expression of Japan's new willingness to defy Western pressure and assert its autonomy. The oil in question, 600,000 barrels of so-called blend crude, was purchased by Tao Oil, a private Japanese refiner, from Russia's Sakhalin-2 project. This project also supplies Japan with vital liquefied natural gas. Because the oil is a byproduct of gas production, rejecting it would risk cutting off critical energy supplies. Faced with that threat, Tokyo not only approved the purchase, it initiated it, fully aware of the geopolitical consequences. While Western nations have largely shunned Russian energy, Japan has chosen to do what it believes is necessary to keep the lights on and the economy running. And yet the situation grows more complex. The import deal is proceeding under a narrow and temporary exemption granted by the United States, a loophole that allows Japan to skirt sanctions for now. This special waiver is not indefinite. It is a diplomatic clock ticking down. But even within that window, Japan is making a loud and unmistakable statement. It will no longer wait for permission from Washington to do what it must for its own survival. Adding fuel to the fire, the oil was delivered aboard the Voyager, a tanker currently sanctioned by both the U.S. and the European Union. Under normal circumstances, doing business with such a vessel would be diplomatically explosive and legally risky. But the temporary waiver, combined with the EU's lack of secondary sanctions on non-member states, has created a legal gray zone through which Japan is navigating with increasing confidence. What was once unthinkable, doing business with sanctioned Russian entities using sanctioned Western blacklisted ships, is now not only possible, but officially sanctioned by Tokyo. This incident shines a harsh light on the growing fragility of Western unity. Japan, the post-war poster child of American-aligned policy in Asia, is now acting decisively on its own behalf, even if that means undercutting the very sanctions that the US and Europe painstakingly assembled to punish Russia. The reason is simple and pragmatic: energy. After the Fukushima nuclear disaster in 2011, Japan shut down most of its nuclear power plants. The country has since grown more dependent on LNG imports. And since oil is a necessary byproduct of that gas production, Japan must buy both to ensure uninterrupted energy supply. If one supply stream falters, the entire energy infrastructure is at risk. When pushed to the brink, Tokyo will compromise, even if it means weakening Western resolve and offering Moscow a financial escape route. And this move could very well serve as a template for other countries seeking similar exemptions. The longer this continues, the more likely it becomes that sanctions against Russia will start to erode. Not through protest or defiance, but through silent economic necessity. But energy is just the surface. Beneath it lies a far more troubling foundation. Japan is facing a deepening economic crisis. Government debt has surpassed 260% of GDP, the highest ratio among developed nations. Inflation is climbing. The yen is weakening. Public confidence is fading. And in a moment of rare and raw honesty, Prime Minister Oshiba recently admitted that Japan's fiscal condition is now even worse than that of Greece during its most catastrophic debt crisis. Once again from Washington, silence. No emergency aid package. No public reassurance. No diplomatic outreach. Japan, once the financial engine that helped fund America's global ambitions, is now being met with indifference in its time of need. This silence speaks volumes. Japan, for decades, served as a cornerstone of U.S. economic security. Its massive investment in U.S. debt helped prop up the very system that allowed the United States to wage wars, bail out banks, and sustain trillion-dollar deficits. But now, as Japan itself faces collapse, the U.S. appears unwilling or unable to return the favor. And Japan is taking notice. The decision to buy Russian oil may have been an energy choice on the surface, but at its core it was a declaration. A message to the world that Japan will no longer sacrifice its own future to preserve the illusion of Western unity. What comes next remains uncertain. But one thing is clear: the age of quiet Japanese compliance is over, and in its place stands a nation prepared to chart its own path, whatever the consequences. Something seismic is shifting in the global balance, and Japan, long a loyal pillar of the US-led financial order, is now staring into the silence and asking hard questions. Why should it continue propping up the dollar when the United States, its decades-long ally, won't commit to standing by it in return? The silence is deafening, and the consequences are reverberating louder each day. Japan is no longer walking quietly in Washington's shadow. It's recalculating, repositioning, and making moves that suggest a dramatic pivot. Other nations are watching, and some are already beginning to follow. The world order that has rested for generations on dollar supremacy and Western alliances is beginning to fracture, perhaps irreversibly. The strain is real, and what's coming may redraw the map of global power for decades to come. At home, the US is bracing for its own reckoning. With mounting internal pressures, the American government could be forced to dump its own Treasury bonds just to keep its economy from stalling, a move that would send shockwaves through every financial market on Earth. If that happens, the reaction will be immediate. Interest rates could surge violently, borrowing costs could skyrocket, and the dollar itself could tumble in value. As confidence in the greenback falters, foreign governments may begin to sell off their dollar reserves en masse, intensifying the economic fallout. What was once unthinkable is now edging closer to inevitability. Japan, sensing the tremors early, is already turning away. It's not just leaning towards self-reliance, it's actively exploring closer economic ties with China, even in the face of political rivalry and deep historical tensions. And beyond China, Tokyo is also reaching out to other Asian nations, stitching together a future where it no longer needs to depend so heavily on Western backing. This isn't posturing, it's preparation. Across the world, the BRICS alliance is shedding its caution and stepping out of the dollar's shadow. Brazil, Russia, India, China, and South Africa are now openly abandoning US treasuries, long seen as the safest asset on the planet, and are instead buying up Chinese yuan-denominated bonds. Brazil took the lead, boldly issuing sovereign debt not in dollars, but in yuan. This is more than a financial decision. It's a declaration of independence. A revolt. A rejection of a system perceived as one-sided, risky, and politically weaponized. The shock of U.S. sanctions against Russia rattled capitals around the world. After the U.S. froze Russian assets and cut it off from global payment systems, dozens of nations took note. Their reserves, too, could be frozen at the push of a button. Sovereign wealth suddenly looked vulnerable. Brazil, once firmly plugged into the Western system, is now looking east, cutting deals with China that offer not just better terms, but more flexibility, fewer strings, and a rapidly expanding financial infrastructure built for this very moment. This is not an isolated story. India, South Africa, Turkey, Argentina, they're all watching closely, with some already laying the groundwork to break from the dollar. Across the global south, the tide is turning. Bonds denominated in Chinese yuan are increasingly viewed not just as viable alternatives, but as safer bets. China has spent years quietly preparing for this pivot, building a robust ecosystem for yuan-based trade and finance. Settlement systems, swap lines, open capital markets, and regulatory frameworks designed to welcome foreign investors. Beijing saw this moment coming and built the scaffolding in advance. For decades, U.S. dominance was rooted in the world's need for the dollar. That need is dissolving. Every time the Fed raises interest rates, other economies bleed. Every time Washington imposes sanctions, access to dollars can disappear overnight. These policies, once tools of strength, are now driving countries away. The BRICS bloc is turning toward the yuan not just as an escape, but as a shield, a way to reclaim economic sovereignty, to chart their own futures. And it's not just about buying bonds anymore. Chinese banks are actively helping other nations issue debt in yuan, structure loans, build investment platforms, and rewire their entire financial systems around a new core. Brazil is already planning to issue panda bonds, bonds denominated in yuan and sold in China, marking a turning point. If a major emerging market like Brazil can raise capital in yuan successfully, others will follow. Momentum will build, and a long, steady shift away from the US dollar will begin to harden into permanence. The consequences for the United States are serious and growing. As fewer countries buy US debt, the government must offer higher and higher interest rates to attract buyers. With national debt nearing $37 trillion, even a small increase in borrowing costs means hundreds of billions more in annual interest payments. The dollar won't fall off a cliff tomorrow, but it is unquestionably losing its special status, the privilege that once allowed the US to print and spend without fear. If trust continues to erode, and if foreign capital dries up, America could soon face the unthinkable, a day when it struggles to pay its own bills. And back in Japan, the shift is equally dramatic. Bond yields have surged. The 40-year government bond recently hit 3.07%, an unheard-of figure in a country long associated with near-zero rates. Even after dipping to 3.018%, that's still 70 basis points higher than at the start of the year. Yields on 30 and 20-year bonds have also jumped. These may sound like technical footnotes, but in bond markets, these are tectonic movements. Japanese investors have responded fast, repatriating massive sums. In 2024 alone, they poured a record 28 trillion yen, over $180 billion, back into Japanese government bonds while slashing foreign bond holdings by half. That's not just a shift. That's capital flight from the United States. Everything points to one undeniable truth. Trust in the U.S. financial system is evaporating. From Tokyo to Sao Paulo, from Beijing to Pretoria, from New Delhi to Buenos Aires, the writing is on the wall. This isn't theory anymore. It's happening. The final question now hangs over Washington. What will Donald Trump do next? Will he move to repair the cracks, rebuild relationships, and restore global trust? Or will he double down on confrontation, accelerate decoupling, and drive a deeper wedge through the world's economic core? This isn't just a chapter in financial history. It's the start of a new era. The old order is wobbling, a new one is rising, and no one can afford to look away.